What happens when one of the world's most influential oil alliances decides to tighten its grip on production and, by extension, the global economy? Their strategic production cuts have sent prices climbing, rattled financial markets, and forced the United States to question just how energy independent it really is. In the next few minutes, we'll explore why heavier crude types matter to U.S. refineries, how global importers like India and European nations are scrambling for alternatives, and why Iran and Saudi Arabia, often fierce rivals, are momentarily on the same page. Finally, we'll examine what this showdown means for your wallet, from the pump to your grocery bill. Strap in, because this is one story that could reshape the energy landscape for years to come. Let's start with a quick overview. OPEC, or the Organization of the Petroleum Exporting Countries, has 13 members, including energy heavyweights like Saudi Arabia, Iraq, and the United Arab Emirates. Together, these nations account for nearly 40% of global crude oil production and over 60% of total petroleum exports, according to the International Energy Agency. Historically, OPEC coordinates supply levels to influence market prices. By cutting or increasing production, OPEC can cause global oil prices, like the Brent and West Texas Intermediate (WTI) benchmarks, to move sharply. Most recently, in April 2023, OPEC announced another round of output cuts amounting to roughly 1.16 million barrels per day, or BD, on top of existing curbs, aiming to buoy prices after fears of a global economic slowdown. The United States, by contrast, isn't part of OPEC and has long pursued a policy of boosting domestic production, especially through shale drilling. However, even with U.S. output hovering around 12 million barrels per day in 2023, this latest move by OPEC underscores a fundamental point. Price and supply power still lie heavily with the cartel, especially when it comes to heavier crude grades. As we'll see, that distinction between light sweet and heavy sour oil is about much more than chemistry. It's about who holds the cards in the world energy game. A decade ago, the U.S. shale boom, driven by fracking and horizontal drilling, doubled domestic crude output, reshaping global oil markets. According to the EIA, U.S. crude output between 2010 and 2020 jumped from around 5.5 million barrels per day to over 11 million barrels per day. This explosion in production dramatically reduced U.S. imports of foreign oil. In fact, at times, the U.S. became a net exporter of petroleum products and crude combined, a remarkable shift from its decades-long status as a top importer. LNG exports also skyrocketed, with shipments headed to Asia, Europe, and beyond. Natural gas, once constrained by limited domestic usage and pipeline networks, found a global market via LNG tankers. U.S. shale briefly weakened OPEC's grip. From 2014 to 2016, prices plunged from $100 to under $40, raising speculation that OPEC's influence was fading. But OPEC had other plans. By coordinating production cuts in late 2016, and again at various points since, OPEC and non-OPEC allies, often referred to as OPEC+, showed they still wield significant power. Saudi Arabia, the de facto leader of the group, can quickly reduce or increase output to steer global prices. With this latest set of cuts, OPEC is sending a clear message. Despite U.S. shale's growth, the organization can still dictate the terms of the oil market, especially when it unites around a common goal. OPEC's production cuts send shockwaves through global markets. After the April 2023 cuts, Brent crude spiked above $85 per barrel, while WTI neared $80. Traders scrambled, and stock markets in oil-importing nations dipped over rising energy costs. For India, which imports 85% of its oil, 4.7 million barrels per day in 2022, every extra dollar per barrel means millions more in daily expenses, widening trade deficits and fueling inflation. Europe, still adjusting to reduced Russian energy imports, faces added pressure. While the U.S. boosts LNG exports, EU refiners rely on medium and heavy crude, mainly from the Middle East. OPEC's tighter supply forces refiners to pay premiums, risking further economic slowdowns. Meanwhile, Russia and Iran, under sanctions, shift exports to Asia. China, importing over 11 million barrels per day in 2022, is aggressively securing energy deals, reshaping global supply dynamics. OPEC's control over supply and pricing remains a key factor in these shifts. But why does the US, a major oil producer, still need OPEC? The reason: crude quality. Most US shale oil is light sweet, but Gulf Coast refineries are built for heavier, sour crude from places like Venezuela and Saudi Arabia. Retrofitting them to process lighter oil could cost billions and take years, making a quick transition unrealistic. As a result, when OPEC cuts production of heavier crude, US refiners face a supply crunch. They can either pay a premium for alternative heavy barrels from other sources or operate less efficiently, potentially passing higher costs on to consumers. This bottleneck spotlights a key vulnerability. Even high domestic output doesn't guarantee independence if what you're producing doesn't match what your refineries need. OPEC is far from a homogeneous bloc. Its members span continents and often have competing geopolitical aims. Nowhere is this more apparent than in the rivalry between Saudi Arabia and Iran, two regional powers with different religious and political alignments. Over the years, tensions between them have flared over conflicts in Yemen, Syria, and beyond. Yet when it comes to global oil markets, they share an overarching interest: maintaining higher prices and ensuring that the US doesn't erode OPEC's dominance. Iranian officials have repeatedly called for unity against US sanctions, while Saudi Arabia leverages its vast spare capacity to fine-tune overall OPEC output. According to Reuters reports, both nations have signaled a willingness to keep production constrained if it means propping up prices in the $80 per barrel range or higher. This temporary alliance within OPEC reflects a broader strategy. Whether a member is dealing with sanctions, budget deficits, or the need for stable export revenues, preserving market power is paramount. Of course, fractures still exist. Differences over quotas and compliance often cause rifts. But for now, these countries are finding common ground, showcasing OPEC's ability to act as a price-influencing bloc despite internal tensions. This cooperation underscores that while OPEC's internal politics can be turbulent, the group can, and does, unify when facing external competitive threats. So how can the United States respond? In broad terms, there are two main avenues: negotiation or confrontation. Negotiation might involve diplomatically engaging key OPEC players, such as Saudi Arabia, to agree on production levels more favorable to global price stability. Some argue that energy diplomacy could ease tensions and lower volatility, benefiting both producers and consumers. On the other hand, a more confrontational approach could be to ramp up US shale production and flood the market, putting downward pressure on prices. This tactic was hinted at in previous administrations, which aimed to leverage America's newfound output to push back against OPEC. However, there's a risk. If prices collapse below the break-even point for US shale, which varies by region but often ranges from $40 to $50 per barrel, domestic producers could face layoffs and bankruptcies. The last major price crash in 2014 to 2016 saw hundreds of US oil companies go under or drastically cut operations. A third option? A mix of diplomacy, shale expansion, and using the US Strategic Petroleum Reserve, SPR, strategically, though that's a short-term fix. In 2022, the SPR reached its lowest level since the 1980s after multiple releases aimed at stabilizing domestic fuel prices. While the SPR can temporarily calm markets, it isn't a long-term fix. Ultimately, policymakers must weigh short-term relief against the financial health of American producers and the broader geopolitical ramifications of challenging OPEC head-on. We've talked a lot about global markets and geopolitics, but let's bring this closer to home. What does it mean for everyday consumers? Gasoline prices in the US typically rise or fall within weeks of major crude price changes. According to data from ALEA, A $10 shift in the price of a barrel of oil can translate into a swing of about 25 cents per gallon at the pump. With the average U.S. driver covering about 1,200 miles per month, those increases add up fast. It's not just about filling your tank. Higher transportation costs can lead to more expensive groceries as trucking companies pass on diesel surcharges to retailers. Online shopping and food delivery services may hike fees to cover rising fuel expenses. If you rely on heating oil, common in parts of the Northeast, your winter bills could climb significantly. The impact can even ripple into air travel, with airlines adjusting ticket prices or fuel surcharges. Higher energy costs can also drive broader inflation, prompting central banks like the Federal Reserve to consider raising interest rates. That could push up mortgage and credit card rates, leaving consumers with less disposable income. In short, the OPEC-US showdown doesn't stay confined to trading floors. It touches everyday life, from the cost of shipping goods to the price tag on your next vacation. Amid all this turmoil, the push for a cleaner, more diversified energy system continues. In 2022, global renewable energy investments exceeded $500 billion, with solar and wind power taking center stage. The European Union introduced the REPowerEU plan, aiming to reduce reliance on Russian gas and accelerate the adoption of renewables, while also exploring new LNG deals. OPEC may hold the cards now, but global energy investments are shifting, slowly but surely. China, which already leads in solar panel manufacturing, has been steadily increasing its solar and wind capacity. By 2030, China plans to have renewables account for 25% of its primary energy consumption, a substantial goal given the country's current coal reliance. Yet, Beijing is also expanding its strategic oil reserves, reflecting a pragmatic approach: transition to cleaner energy while safeguarding itself from global supply shocks. In the U.S., debates over how quickly to transition from fossil fuels are intensifying. On one side, climate advocates argue for rapid decarbonization, pointing to increasingly extreme weather events linked to climate change. On the other, energy security experts warn that moving too fast could lead to supply disruptions and higher costs. According to the EIA's annual energy outlook, oil and natural gas will still make up around 50% of the U.S. energy mix in 2050 under current policy trends, even as renewables grow significantly. OPEC, meanwhile, shows no signs of relinquishing its influence. Saudi Arabia is investing billions in expanding its maximum sustained crude output capacity, a move designed to maintain its status as the world's central banker of oil. While the transition to renewables is real, it's unlikely to fully displace oil in the near term, meaning OPEC remains a major factor in global energy decisions. Let's envision a few possible scenarios for how this face-off might play out. First, a prolonged standoff. OPEC maintains tight control over production, keeping oil prices elevated. The U.S. tries to boost shale output but runs into cost barriers and refinery mismatch issues. Consumers could see persistently high gas and heating bills, and inflationary pressures might linger. Second, a short-term truce. Diplomatic efforts smooth out tensions, resulting in minor production adjustments that stabilize prices somewhere in the $70 to $80 per barrel range. This could temporarily relieve price pressures, but the underlying friction, America's push for shale dominance versus OPEC's market control, would remain unresolved. As soon as demand shifts or a geopolitical crisis hits, we could see another round of production cuts or expansions. Third, a market reshuffle. Countries diversify their energy sources aggressively, spurred by ongoing high prices. Renewables expand faster than projected, nuclear and hydrogen gain traction, and the global economy gradually reduces its reliance on OPEC crude. In this scenario, OPEC's power diminishes over time, but it's a slow process, given current infrastructure and consumer habits. In reality, the outcome might be a mix of all three. What's certain is that oil remains a cornerstone of the global economy. While renewables are growing, the world is still heavily dependent on crude for transportation, plastics, and industrial processes. OPEC's ability to act cohesively coupled with America's significant but not all-powerful shale sector, sets the stage for ongoing volatility. The result? Energy prices that can swing on a dime, right along with the fortunes of everyday consumers and businesses worldwide. So, what's the bottom line? OPEC's production cuts are a calculated move to keep oil prices stable, or high, depending on your perspective, and remind the world who still holds a commanding position in the global energy market. Meanwhile, the United States, despite its impressive shale output, faces persistent refinery and logistical challenges that prevent full independence from foreign heavy crude supplies. As consumers, we'll likely feel these shifts in everything from the cost of filling up our cars to the price of goods on store shelves. The bigger question: will this stalemate push countries to invest more aggressively in alternative energy, or will high prices simply continue fueling geopolitics and inflation? The real question isn't just who controls oil today, but how long oil itself will remain king. What do you think? Will we ever see a world where OPEC doesn't matter? We want to hear your thoughts in the comments. Which scenario do you think is most likely? Prolonged standoff, short-term truce, or a full-on market reshuffle? Let us know, and don't forget to like this video, subscribe for more deep dives, and hit that notification bell. Thanks for watching, and see you in our next episode.